So I am recording. If you're getting stumped tonight on the B set, just rewatch portions of the recording and I think you'll be okay. Starting with problem 12.1a, we're going to do just a few portions of it. We're not going to do the C portion. But in the book, I'm on page 599. A post-closing trial balance, meaning the whole accounting cycle is done. Here is the last thing for two proprietorships. So in other words, Sorensen Company and Lucas Company want to merge. Here's their closing stuff for each of their sole proprietorships, and they decide to form a partnership called the Solu Company, and they've agreed upon valuations down here. So I want you to look in your book. I don't have anything on the screen for this, but let's just take a look at Sorensen for a minute. He is going to present, and I shouldn't say he, but let's just go with he. He's going to present $14,000 cash from his sole proprietorship. And his AR is valued at $13,000 or $17,500. But then the allowance for doubtful accounts is valued at $3,000. But take a look at the bottom. His AR, yes, is going to be $17,500. But when they merged their partnership, they must have decided, well, we're going to actually bump that allowance of doubtful from $3,000 up to $4,500. So do you see how, although what's up here is what their books ended with, when they merged and did their handshake and signed their papers, they valued their non-cash assets at a little bit different. Okay, that threw me too. I kind of didn't see that middle section when I was doing the problem last night, and I'm like, wait a minute, why are my numbers not working out? Oh, they agreed on some different numbers. Take a look at the inventory. Sorensen's inventory was valued at $26,500, but down at the bottom they valued it at $28,000. So just notice the differences, okay? And they want you to prepare separate journal entries to record the transfer of each of the sole proprietorships to the partnership, and then each partner is doing one additional investment. So here we go. I think the first one is for, just pop down here. This is the Sorensen one. How much cash is Sorensen bringing from the sole proprietorship to the partnership? $14,000. Cash is going up. Is he going to ditch his AR, or do you think that he owns the right to getting paid still? He owns the right to getting paid still, $17,500. Is there a contra asset that goes with that? Yes, the allowance. Mallory's correct, but we're going to wait. That's going to be a credit. Okay. Inventory, is that a cash asset or a non-cash asset? Non-cash. His value was $26,500, but they agreed on a $28,000 investment or a value of that inventory. Here's a question that I know I saw in the practice test that I think will also filter over to the actual test. When people combine a partnership, that inventory is no longer Sorensen's. It's the partnership's. So when people bring non-cash assets to the table, when they form, they're no longer exclusively theirs. It becomes the new partnerships, just so you know that. Okay, what's the next item that we're going to debit? Equipment valued at $25,000, although it was $20,000 or $45,000. What happened? I don't know. The other ones must have said, your equipment's junk. We're going to devalue that. And here's where the contra asset shows up. Notice it's the 45, not what was said before. What else does Sorensen have dragging behind him? The liabilities, notes payable and accounts payable. He can't just say, meh, I'm not going to pay my bills. those liabilities still exist. Where did we get the numbers for those? Up here in his trial balance. That other contra asset, accumulated depreciation, does not tag along. It does not tag along. Rather, it is like, all right, when we're going to form this partnership, we're going to start fresh with accumulated depreciation. Yeah. So what's left? We have one credit left. It's a forced number to know what Sorensen's capital value is. This number of 40,000 is forced math. It's all the debits equal all the credits, and you'd be left with a $40,000 balance. So that partner going in is worth 40 grand. Right now, I want you to try to do the transaction for the other partner, Lucas. Fast. We've got to move fast today, otherwise we're not going to get through all this. So he brings $12,000 cash to the table. He's got some AR, he's got inventory, he's got equipment, but remember, they're handshaking on different dollar amounts. Remember, we are not concerned about accumulated depreciation. You're going to be doing all of this for the B set, but it's okay to just have you do a few on your own here during class. Make sure you're on the right track with the debits. They're on your screen. We've got a contra asset account offsetting the AR. Although it was listed at 4,400, they agreed on 4,000 down in the bottom. A few payables that Lucas owes. And you'll arrive at Lucas, capital by doing some forced math. I'll just give you the number so you don't have to plug it in. That's like Lucas's overall worth going into the partnership based on all the assets that he brought, and then minus the contra assets and the liabilities that he owes. Yep. On your side margin, or even just rip right through here, this is the initial investment in the formation of the partnership. They each had their own sole proprietorships. They shake hands. Hopefully they got a lawyer involved to write up the contract. But this is what they bring to the table. This is the initial investment. The problem talks about an additional investment. Further, it is agreed that Sorensen will invest an additional $5,000 cash, and Lucas will invest an additional $19,000 in cash. So they're saying, in addition to what they've done, they're going to have 2 more additional cash investments. And that just simply is increasing the business's cash and also increasing their capital or their overall worth. don't think we did that during the lecture and mid-chapter work, but it's pretty easy. So what happened here in B versus what A happened was the initial investment. This is additional investments from each partner. For all of those transactions, the only forced math is that initial investment on their capital worth. Okay. But is it pretty easy? Pretty straightforward? Good. And I know I moved quickly. Do we have questions? The C set, and I want you to very abruptly in your workbook cross the C part off. I'm not going to have you do a balance sheet. There's not very much availability for it on the test. We didn't talk a lot about it during the chapter. No balance sheet. And the reason I want you to very obviously cross that off is when you're at home tonight doing the B set, you don't do that. So that's section 1. Cool? Let's go on to 12.2. This is a lot more involved. Take a look at what we're going to be cruising through here. And then we also have one of these where we have to say, all right, how are we dividing the net income? Okay, so I think we can do this. I'll take it step by step. So 12.2, here we go. At the end of the first year of operations, the NBS company shows the following. It looks like we have Art, Greg, and Krista. They've got drawings and capital balances. The capital balance represents each of the partners' initial investments. Therefore, net income or loss has not been closed into the capital accounts, and so they want you to do that. So like that was their startup balance, but now they've worked a year and we've got a net income or loss and we have to account for that and divvy it out. What we're going to do here in 1, 2, and 3, there's 3 separate ways to analyze it. I think I spelled that wrong. We're looking at this 3 different ways. In 1, they're saying net income is 30 and their ratio is 6, 3, and 1. In number 2, they're saying net income was 40, and then some of them have a salary allowance, the other don't, and then the remainder is shared equally, and then 3, something totally different. So these 3 do not relate. There's 3 separate ways to look at it. Okay, so what we do in 1 does not happen in 2. Does that make sense? Okay, so let's look at 1. If net income was $30,000, which means we had more sales than we had expenses, how would the partners share this if it was a 6-3-1 split? First of all, the income summary would be a $30,000 debit. If you think about when you're closing stuff and you've got that little holding tank income summary, this number, which let's just use, I don't know if these really were the sales, but to close sales, that'd be here. And then if we had expenses of $70,000, here's what we're looking at. Well, what's going to get the income summary to be washed out? Well, putting $30,000 right here. And if sales were more than expenses, it's considered net income. Okay, so we've got $30,000 to share between the partners on a 6-3-1 split. Okay, we've got each of the partners there. We're sharing that $30,000 with the 6-3-1 split. So you can look at that a couple ways. 6-3-1, which 6 plus 3 plus 1 is out of 10. So, you know, 60%, 30%, 10%. You can look at that a couple ways. If you would rather, instead of putting 6%, take 6 divided by 10, 3 divided by 10, and 1 divided by 10, because of the nature of the 10, it shakes out to a percentage anyway. Why does Nienstad get so much more? Because he's 60% in, so he gets 60% out. That's the easiest way to do it, when they're just like, here's our ratio, split it. What if it would have been 2 partners at a 50-50 split? How much would have each of them got? 15,000, okay? This is the easy one. You get into some partners saying, well, we want to get paid. We want a salary allowance on top of it. Well, that's what the next situation looks at. Do you have any questions on the first version of this before we move on? As we move on to the second one, does it relate at all to the first one? Nope. They're just saying, here's a new net income. Here's a new few scenarios. Now try it. Let's read number 2. I'm on the bottom of page 599. Same 3 partners, but this time net income was 40. Nienstad and Bolin are actually given a salary allowance of 15,000 and 10,000 respectively. So one gets 15, one gets 10. The other partner must not have a salary allowance. And then the remainder of money is split equally. Doesn't seem fair, does it? But if that's how the partnership was set up, that's how you go. So which partner is not getting a salary allowance? Saylor. She has no salary allowance. So it's still net income. This time it's like 40,000 instead of 30. If that's a debit, that means that we had another net income. I wish, disregard this part for a minute. Just disregard the 3 credits. Here's how you figure out why they're splitting $5,000. Do you have space in your journal for this? Do they have it kind of laid out nice or not? It's weird? Sweet. Okay, good. Good. Because my answer key doesn't. So here's your calculations to figure out why they're splitting 15,000 3 ways. Started with a net income of 40. These 2 had a salary allowance. Nienstad had 15, Bolin had 10. So when you take 40,000 minus 15 and minus 10, we have a remainder of 15 to share, because the book says we're sharing that equally. Saylor doesn't show up in that list because she's not in our list in the book. It does. So doesn't it look like Saylor's getting kind of the raw end of this deal? But Saylor maybe doesn't ever work. Maybe she's a silent partner. Maybe she's just like, hey, I'm going to give you some money, but I don't want to ever work. And if there's a little extra net income left over, I'll take my little share. Does that make sense? And that happens. Sometimes there are silent partners. So then we're going to take a look at our 15,000. Oh, we have lots of guests. Hi. It's that first door over there. No, that's okay. Now you can either take it times 1/3 or you could divide it by 3 to find out, and you can see that 15,000 shared among 3 people is going to be $5,000 each. So then we go back up here. Are you guys done with this part? Okay. Then we go back up here And like Mallory asked, so you mean the salaries come off of the net income? Yes. So Nienstad was paid $15,000 plus the 5 little cut of what was left of net income. So actually, his capital is going to go up by $20,000. Same thing with Bolin. He had a little salary of 10 grand plus his, shared equal split of the 15. But then poor Sailor only gets 5. So if you've got a highlighter, maybe do this. I'll circle with a different color. Like right here, those are the salaries. And right here, this was the equal split of the net income remainder. Whew, a lot of information, isn't it? Moving on to scenario 3. Scenario 3 has nothing to do with scenario 1 or 2. Let's read it. Net income is $19,000. Each partner is allowed interest of 10% of their beginning capital balances. Where are we going to get those? Up above. The 48, the 30, and the 25. Do you see those? Nienstad is given $15,000 of a salary allowance too. The remainder is shared equally. Put your net income in of $19,000. You're going to see the 3 credits, but I'd rather talk down here. I think we'll go line by line. That's going to make it easier for you to look at. So go to the calculation part. Here's our $19,000. Each partner gets to just have $10,000 of their capital balance. Kind of like as a little, hey, thanks for running a capital balance. We're going to give you 10% of that back. Why are these seen as negative, though? Why are we subtracting these from our net income? Money has got to come somewhere. Like Mallory just said, it's taken out. So now our new balance is down to $8,700. We made $19,000. The partnership agreement said, well, we're going to pay you 10% of whatever your capital balance is. But then what's our next little roadblock before we can share our net income equally? Do one of the partners get paid a salary? What's our problem? Nienstad gets paid $15,000. What's our problem? We don't have enough money. So back up here, we got a $19,000 net income. Each of our partners have an interest allowance. One of them has a salary allowance. And we are $6,300 running on what's called a deficiency. I explained this when I explained this part of the chapter. Although we had net income, we're left with a deficiency for 2 reasons. Why? No, we've paid him almost too much. We've given him too much of an interest allowance, and then that Nealon guy, Nienstad, paid himself $15,000. So although it's a net income, it's considered a deficiency because we don't have enough money left over because they've been too greedy on the other end. They've gotten that interest, they've gotten that salary allowance. So now we have to share this deficiency equally. We take that 6,300 we're short, divide it by 3 or multiply it times 1/3. Each partner is going to take a $2,100 hit because they're sharing that equally. Now it's really boiling the blood of the other 2 partners. Why are we paying Nienstad so much? We're taking a hit instead of getting a bonus. It's just how the partnership was set up. So this is seen as a hit against capital. Even though we had net income, it's seen as a hit against our capital. So you go back up here, Nienstead's sitting pretty good because he gets paid $15,000. This was his, let's see again, I'll draw in here. This was their interest, 10% of their capital. Then this ripper got a salary for whatever reason. And then these negatives were because of the deficiency. That's getting really technical, you guys. Your body language tells me you're getting it. Yep. Are you going to see something like this on the test? I tried to avoid all the deficiency stuff. That really messes with things. What would have solved this scenario 3 problem? Not doing the interest, or not paying Nienstead or Neaston or whatever his name, 15 grand. Or try to do something to boost sales because we only had a $19,000 net income. Do you see where partnerships fold? Because this is messy and it seems a little bit unfair. But we don't know the backstory. We don't know the background story. We don't know why Nienstead gets paid so much and the other two don't. The cleanest way was scenario 1. Would you agree? Probably. All right, so now we're going to divide this all out visually. It's a little bit better, I think. We're going to take all of that same data that we just journalized and put it into a better format. Do you guys have a nice chart for this? Is it, like, do you have headings like this? Are the names there? Do you have anything recorded over here on the left? Okay. Let's take it slow. You are going to have one of these on the practice test. I don't believe it's going to be a deficiency-based thing, so that's good. But it's a wide open piece of paper. So if you want to build yourself like a little chart with nice columns, you can. Think of this like an Excel document where there are rows and columns. All right, so Art Nienstead gets a salary allowance of $15,000. 15,000 plus 0 and 0 equal 15,000. Do you have a total column? Sweet. Then they have all their interest. Interest allowance on capital. So they're running, $48,000, $30,000, and $25,000 balances. And the partnership agreement was that they get 10% of whatever they run on their capital. I'm going fast because we journalized all this already. $48 plus 3 plus 25 equals 10,300. One thing I didn't write down that I knew I should have, at the very top, put 19,000 net income. I like this visual because you see where the money's going. Nienstead got 15,000 salary. All of them got a little cut of their capital. So the total interest and salaries paid break it down by partner to equal 25,300. We see a huge problem already because we only have 19,000 in net income. So we've overpaid our people. hopefully you have a little side margin or bottom area that you can write in. Let's do the math. We know that 6,300 is our deficiency, but let's take our 19,000 of net income minus our 25,300 is what we basically paid to owners, equals a $6,300 deficiency. I can't say it enough. We had a net income, but it's a deficiency because we paid our owners too much. They said that they shared income and deficiencies equally. So you basically just take that $6,300 and divide it by 3 to equal, was it 26 or 21? And each of the partners have to have a hit against what was in their kitty up here. Here's their kitty. Now we're going to subtract this hit against their capital to show what they actually got out of the net income. What if this would have not been a deficiency? What would we have been doing to their share? What if it would have truly been a surplus? Would we subtract? No. If it had been a $6,300 surplus, not a deficiency, we would have added the 2,100. Okay? That's why this problem set is harder than the test. And then you see that $19,000 net income number again. You can cross off C. We have 15 minutes to do one more problem. We can do it. What do you think's happening in problem 3? Problem 1, we formed the partnership. Problem 2, we divided our net income. Problem 3, we're getting out of town. We're liquidating the partnership. I took a quick stop and said, all right, I don't think I'm going to use the T accounts right now, but 4 things we do to liquidate. We first sell our non-cash assets. We second allocate the gain or loss on the, tell me the word. When we sell non-cash assets, it's not a net income or loss, it's a gain or loss on the, starts with R. That's a question on the test. You better know that one. Then third, what do? You guys, this was yesterday. And then what do we do for number 4? Split what's left. I'm a little worried. Problem 12.3a. Here we go. Yep. Yeah. Been nice weather. Here was what we got to do before we leave. So let's do this. Here we go. number one, we're selling our non-cash assets. Well, let's take a look. We've turned the page over to 600 in the book. Okay, if there's time. Yeah. How about let's do this problem first. And then we can, if there's time at the end, we'll talk about it. Problem 12.3a. The partners share income and loss on a 5-3-2 split. So 5 out of 10, 3 out of 10, 2 out of 10. During the process of liquidation, the following transactions were completed. Whoa, there's 5 instead of 4. 4 and 5 kind of go together. Here we go. A total of $51,000 was received from converting non-cash assets into cash. So we got $51,000 for selling all of our non-cash assets. But when we did that, some stuff is gone. We actually have to list our contra assets first because those normally have credit balances, and so to get rid of them, we debit them or zero them out. Allowance for doubtful and accumulated depreciation. You might say, whoa, I thought we didn't deal with accumulated depreciation. That's when a partnership's forming. But yes, you do accumulate depreciation as a partnership goes on. Spoiler alert, Mallory asked about this yesterday. We had a loss instead of a gain. The reason that's a debit, and you know about that already, is because it's one of the debits instead of the credits. And you'll see how the numbers shake out in a minute. What amount of ARs are gone? 25,000. I sold inventory for 34.5. Equipment was gone for 21. Okay, I'll explain all of this. Why don't you get your numbers down so you can make some notes on things. Do you have a little calculation area? It's why you see the loss. Our sales proceeds, we got $51,000 in cash, but our non-cash assets were valued at 74. So we sold them for less than what they were worth. Now, when you see the word net, that's taking into account these two contra assets. The contra assets are subtracted from that value. So we basically took 25,000, 34,500, and 21,000, those three non-cash assets minus the contra asset values to get to that 74,000. So these three assets minus the value of those contra assets is what got us to 74. $74,000 worth of non-cash assets that we only sold for 51. This was a loss of $23,000. Had it been a gain, it would have been a credit. A gain, I want you to write this down. We did this yesterday during lecture, during the 12-9 exercise, but a gain on the realization would have been a credit. And Mallory asked yesterday, I'm glad she did, so if this would have been a loss, that would have been a debit, right? Yep. And you see it happening here. This is harder than what you're going to see on the test, but this is all the options I had for the problems. So number one, we've sold our non-cash assets. We have a loss on the realization, but you know what we have to do? We have to share that loss. Because in number two, we're allocating that loss. So let me find a new pen color here. we have a debit here, so to get rid of that loss and divvy it among the partners, we credit. It's like a wham bam. Like we have it happen and then we get rid of it right away. Now, where did we come up with the 5-3-2 split? Well, the book said it. I'm going to write it up here. 5 plus 3 plus 2 is 10. So the first partner gets 5 of 10. The second partner gets 3 of 10. And the third partner gets 2 of 10. 50%, 30%, 20%. Now, think about when a capital account is debited. Is that a good thing? No. This is bad. I want you to write this down, but then I'm going to go back to a T account to show you that this is a bad thing. When a capital account is debited, that's a hit. I'm not going to put each of the 3 partners up here, but I'll just show you. So if this is capital, the credit is the plus. Well, we just put a number here, so that's a hit. Why? Because we sold our assets for less than what they were worth. Okay, so number 1, we sold our non-cash assets. Number 2, we allocated the gain or loss. Number 3, we got to pay our bills. Yes, what I just wrote here. Yep, good question. You'll see a gain in the practice test. Number 3, we got to pay all of our payables. We can't just walk away from this business, liquidate, shut our doors without paying our bills. Be in trouble legally. Where am I coming up with those payable amounts? Well, they're listed over there. Notes payable, accounts payable, salaries and wages payable. And we had to use cash to do that. Cash goes down. Then when payables are debited, kind of like what we just saw before, they're zeroed out or wiped out. Someone's calling me. One to go, but sort of. We have a 4 and 5, but it really could be roped into 1. And we're going to read about it. What's the last step? We split all the leftover money, right? Well, let's take a look at where our cash shakes out. I'm going to go back a slide. You don't have to do this, but I think T accounts sure are helpful. So cash. Oh, where was cash sitting before we were done? We had a $27,500 balance. I'm looking, I got that from the balance sheet. Okay, but then we had a plus 51,000. Why did that happen? We sold our assets. But then we had a minus of 44,500. What happened there? We paid our bills. So I'm gonna. This one is when we sold our assets. This is when we paid our liabilities. Do we have some money left? We do. We have, is it 40? What are we splitting here? I can't do my math. 27,500 plus 51,000 minus 44,500. Our human calculator is gone. Yes. I don't know what it is, but we have money still in our cash account. Okay. 34,000. So we'd usually be splitting that 34,000, but we've got a problem. Here's where it gets hard. Our partner, our roper, has a deficiency. Like we paid him too much and he has to take a financial hit first. Okay. So we're gonna take his capital of $46,000, which that amount came from right here. Not 46,000. 4,600. But guys, look at what his capital balance is. Look on page 600 where it says P. Roper Capital. He only has, Jameson has 33,000. Moyer has 21. They easily can handle that hit that they took, but our roper only has $3,000. Right here, the hit cost him $4,600. And so we take the hit minus his balance. He actually had that deficiency that we had to first account for. And then we get down here. Now, where are these dollar amounts coming from? The 33, the 21. I have to just look in the book here a minute. Paid cash to the partners with credit balances. This is where I knew I made those T accounts because it showed it, painted the picture a little bit better. I'm going to go back there. I knew I made those for a reason. How are we doing on time? I know we are, but give me a minute. Jameson, Moyer, and Roper. He had a $3,000 balance, but his hit was this. So we had to cover that deficiency first. Well, 3,000 minus 4,600 is a deficiency. Like that's not enough money to cover what he, so he had to put 16 in to even get it to shake out. Okay. I want to cover this right when you walk in tomorrow because I want you to see where those numbers came from. As far as the B set being way different, see what you can do with it. However, focus on the practice test. Okay? Put your focus on the practice test. Do what you can with the B set.